Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Rick Bensignor, founder and CEO of the Bensignor Group. Rick, welcome to the show.
Thanks, Michael. Pleasure to be here.
All right. You are a longtime veteran in the industry. When did you first get started?
I actually started in the early 1980s, came out of college, got a job with Prudential Bache, was upstairs for a year or so in the compliance department, and a year later, they sent me down to the floor, and within a year, I was in the pit. I was their stock index futures trader, and actually lived through the '87 crash, which still is one of the craziest days of my life.
Was that one of the most important days of your life also?
It certainly was one of the most important. I'd say career-wise, at least especially from a trading perspective, the mini crash in 1990 was actually the most important day. Very few people know this, certainly within my family, although more people know it because I've spoken about this publicly elsewhere. But I was trading stock index futures in the pit. I don't know, it was 2:30 in the afternoon or something. And all of a sudden, I'm making a two-sided market, and a guy sells me, I think it was like quarter bid at 30. Don't remember what the handle was back then. He says, sell you 10. And before I even have the thing carded, we're offered limit down. And I start, so back in those days, we closed for, I think, 15 minutes for the world to kind of evaluate if this was proper pricing, and, panic in the air. And I was calculating how much I was down on paper. And I realized it was not only more money than I had in my account, but it was kind of like this was going to wipe me out for good. It'd be my last day trading.
Right.
And I'm thinking, how am I going to tell my wife? And, it's a disaster. While we're limit down, a broker who was standing behind me got a buy order. And he said, who needs to sell some? And I got in his face so quickly, I didn't let anybody else get him. And he said, buy 15. So I've locked my loss at limit down, and now I'm short of limit down. Thank God we opened the next limit down, which was even a larger price move from where we fell to the first limit down. I covered the 5 lots. In fact, I bought the 7 at the second limit down, kicked them out as we started to bounce, and I turned the day that was going to end my career 20 minutes later into what ended up being the second best day I ever had in my 12 years trading in the pit. Yes. It was an emotional roller coaster that I don't wish on anybody.
You immediately got off the floor and had to go sit down for a second to catch your breath. I'm sure of it.
Yeah.
If not, run down to the nearest bar and say, oh,
yes.
I'll take a double.
So that was probably the day in my career that I realized as much skill as you have, there's a lot of luck too, to making it or not in life. And if I wasn't the person who that broker had bought those contracts from and flipped my position, and I was still long at the second limit down, we'd probably not be talking today.
From one insider to another, none of that could have happened if you panicked, didn't hold your nerve, and know what to do next to get out of that jam.
Yeah. Yeah.
And only somebody who's been there would know, don't panic. How do I fix it? Brilliant move. Okay, you are one of Wall Street's foremost authorities on behavioral finance theory. Talk to me about that.
Yeah, so years ago, I kind of started, when I say years ago, I'm talking 20 years ago, in the late 90s, I started understanding just how much psychology had to do with market movement. And I'm not talking about just some of these polls that come out that say, AAII poll that says too many bulls or bears, but how much more there's a deep relationship that human beings have with money and how much it affects their decision making. And I realized that at market turns, often the worst decisions were being made by people who couldn't take the pain any longer of a bad position. And I started working on models to exploit those bad decisions others made. Ultimately, years later, New York University came to me. I had already taught several courses there. They came to me to spearhead their entire behavioral finance certificate program, which was essentially 5 different courses that we developed. I wrote the main course and taught it. And academically, it was now pursuing this new very hot subject on Wall Street called behavioral finance. What I've done since then is be able to take the academic concepts of behavioral finance, and I believe that I am one of the very few on the street who has figured out how to take them and actually trade markets, understanding these academic concepts, but taking it beyond the theory and be able to help call market turns and real extreme exhaustion points in the market. So that's what I do for clients.
All right. Now, that being said, is a very high-level statement about what you do. Give me an example of being able to take the behavioral finance theory and put it to practical use. What do you look at, and then how do you execute?
Okay, so here's one of the things we did recently. You've seen up through the summer, a massive move up in the oil market. And we eventually peaked at 76 a couple months ago. The last thing we had done formally for our clients was we were long oil at about 63.5, and we sold out at 73.5. And once we were out, we were very cautious about having any long exposure in oil. And we had noticed a multitude of factors that said, even though price was still kind of creeping higher, the bigger factors at play from an emotional point of view and from what the market's telling us is telling us something's very wrong here. So we kept cautioning our clients not to be long oil.
When you say, let's drill down into this.
Sure.
When you say an emotional point of view, what do you mean?
All right, so there are a variety of factors that go into markets moving higher, besides just bidders pushing the market up. Why are bidders pushing the market up? What are the fundamentals driving it? Are there technical factors? Is it pure fundamentals? Where are the analysts on the street? One of the things that we really felt we took advantage of is that you could not find an analyst on Wall Street, an oil analyst, who was not saying $80, $90, or $100 oil was coming just around the corner. Now, something as simple as looking at a price chart and a long-term chart of oil told you that the mid-70s was actually a place you'd expect it to run out of steam. And that even comes from a simple downtrend line from the all-time highs. Kind of came in just about $76. So we knew up against that level, we don't want to really partake and jump into this boat, because if it broke out to the upside, I don't care if I pay $78 for oil, but then at least I have a clear sense that it's really breaking out higher. There was way too much euphoria in the market. The sentiment, using the particular sentiment poll that we find most useful, got up to 96% bulls in the futures markets for crude oil, which is virtually an unheard of number. You had all these analysts who were bullish, and everything we're looking at, from exhaustion models to even a simple trend line, which is not something I typically make a decision on. We use much more sophisticated type of analytics, but everything was leaning towards, you've got to be long oil. The key to me was, having been a futures trader and somebody who grew up in the commodities pits, I was watching open interest in the oil market. And in a good bull market, open interest should be moving up as the market moves up.
And volume.
And volume, correct. In May of this year, NYMEX's open interest peaked, which meant the entire rally from the 60s into the mid-70s was on declining open interest. So what's that mean? How does open interest go down? It means people buying futures contracts are buying and covering shorts from people who were previously long and getting out of their longs. So you had a major short squeeze. The funds were on the wrong side.
They were previously short, and then now the pain threshold, that's a short squeeze.
Correct.
Right.
Correct. So you had lots of commodity funds who were short oil. They were forced to pay up as losses kept mounting and the price kept going higher. Right. So as they bought their contracts and exited, they were exiting to people who were previously long who are now getting out. In other words, both people were exiting their futures contract. That lowers open interest. So this big bull market that we saw was coupled with declining open interest. That, to me, is a sure factor that shorts are covering. That's not what you want to see if this was really an authentic bull market. So when we put several pieces of the puzzle together, we said this market's not going up. we weren't telling people to short it, but we simply said you don't want to be partaking on the long side here. And to me, that's just as valuable as telling somebody to short something, is don't partake in the upside when the timing is wrong.
This isn't that gets back to the super simple methodology that J.P. Morgan said, when the shoeshine boys starts giving me stock tips, I'm out.
Sure.
I get your point.
The perfect storm happened with all these analysts turning bullish up against this kind of mid-70s level, which we looked at as not, you really had to get to 80-ish to think that you could potentially go higher. Oil started coming off, and as it came off, and it even broke under 60, which was already now a 20% decline from a peak somewhere near 75. It was 76 and change, right? 20% down move. Now, official bear market, if you want to use the textbook terms. We still saw that open interest was declining. And this was kind of, now you're talking about a massive move out of the oil market. This is way more than the fundamental analysts were saying, which was a response by the Saudis to simply appease our president and kind of bring oil back down to a more favorable level. Ultimately, we sold down recently to $50 a barrel, right? So now oil's lost 33% of its value in a matter of 8 to 10 weeks. We've been saying now for several weeks, and we might be the first on Wall Street to say this, we think not only is the cyclical high in for oil, but we think the secular high is in for oil, and that you may never see oil again at $75 a barrel. We think there is a dramatic shift going on globally in the oil market. It doesn't mean people are going to step away from needing oil, but the supplies are plentiful. And as time goes on, even the major oil producers are spending R&D, research and development, into alternative non-fossil fuels.
I was just going to go there.
We think that this was the first leg down of what ultimately will be the decreased demand for classic traditional fossil fuels and the beginning of a much more serious demand into the alternative type fuels.
Renewables.
So, yeah. Right. Don't get me wrong, oil's not going away. You know, this market's not going to fall apart, but you don't sell off 33% in one of the world's most major commodity markets on simply because the Saudis decided that, you know, we're going to appease. There's a bigger play at hand, and we think that's what the play is. So this is something that when, you know, I've been in this business now over 35 years and have heard every criticism you can possibly hear from people who say, we only look at fundamentals. We don't care about quant. We don't care about behavioral. We don't care about technical. The fundamentals drive the market. Well, look where all the analysts were on the street. These supposed experts who know far more about the oil market than I do on a day in, day out basis, all were bullish at the top. To us, it was the perfect storm. It was the last hurrah, and people got crushed. And where are those analysts now? How come we don't hear a thing from them?
Yeah, well, you know, how do you call your waiter in New York, or how do you call your broker in New York? Hey, waiter.
Yeah.
Yeah, I've heard that. But anyway, so getting back to the oil market, based on my Fibonacci, which is different than what you're doing, and taking into account what you were just saying, are we looking at a potential base somewhere in the low 20s?
I actually think over time you will see that again. So we will revisit the lows made a couple years ago. I think it was, 2016, when we got down to $26, something like that. It's not coming immediately. It's not coming in 2019.
But you can trade a long, slow grind.
You absolutely can. And I think, and what we've told our clients is,
okay,
the next big trade in oil is not picking the bottom. It'll come at some point, and you'll make some money if you're tactical and you can get in and out well. You'll make money. But the smarter move is to figure out where to get out of oil and where to ultimately short it, because we think you're not getting into the 70s handle again. Not now. Can I say forever in your lifetime? No, but I would say for years coming, and possibly never again. And that's a big call.
Yeah, for futures lifespan is you know, you and I pegged it, 30 years. That's generally a decade. That's our lifespan.
Yeah.
All right. Anyway, now I was just at a Christmas party at a charity event and talking to a fairly affluent Morgan Stanley money manager, and he handles funds for individuals that have family offices, but they've been with them so long, they put some of the money with the family office and they leave a lot of it with him to manage. Sure. He's been having a wonderful time over the last several years. The market's always been bailing him out. Not that he's brilliant on his own side, but one of the key, and to your point on behavioral finance science, he says, not one of my clients have called me. This was on the last drop that we just had, that 800-point Dow drop. Not one of my clients called me and got nervous. I was like, okay, well, panic's not in yet. Right. We're in a current market where today it's, I think it's like, 500 points?
We bounced actually a little bit just before we went on air. It did bounce off of the lows, but it's still, the market's still getting hit hard today. The S&P broke under the low from the Friday after Thanksgiving, but it's back above it as of 10 minutes ago.
Yeah, and day's not over. But using your behavioral finance theories, where are we now? What are you thinking?
So we've been in a large trading range for the last couple months since we put in that low down in the, where was it, 20, God, I can't remember, 2603 or 4, I think, something like that was the low of the move. We got back up for a third time on Monday this week to 2800. Then we've collapsed again. So we're in this large trading range. What's interesting in the last month or so, as volatile as the market feels and is on a day-to-day basis, volatility actually hasn't really moved up much in the last month. If you look at the distance between the high Bollinger Band and the low Bollinger Band, it's pretty flat. It's just about 200, 210 S&P handles. So volatility hasn't actually picked up in the last month. We're just seeing big ranges where we've moved 150 plus S&P points in days, both up and back down. We think that, and I called clients this morning, 2632 to 2616 needs to hold. If we break under that zone, we're talking about 25, I'm trying to remember, 2513 to 2473 is the next downside target. Many people on TV, and as you just mentioned, said we haven't seen people really puke out. You haven't seen that capitulative move. So right now, I actually did some buying today. I bought some Apple on the open for my own account. I bought some IBB, which is biotech stocks. I'm kind of still playing that we potentially can be in the range, but I'll have tight enough stops that, I don't have to risk much more than using the S&P as my benchmark. If we fall another % or so from today's low, or even 0.5%, I can lighten up on virtually everything. I'm always in liquid names, and then play for another 100 plus S&P points on the downside. So we're kind of at the bottom of a range that continues going back and forth. And one of these days that range will break. We'll either break above 2815 or break beneath kind of this 2620-ish level and change the range. But for right now, we're still in it.
Okay. Are there time frames on your behavioral theories? Because some people are real short in their time frames intraday, and some people are looking at bigger trends. Yeah. And I've talked to people who work in this theory with algorithms for computer models, and I wanted to get your perspective on your sweet spot for using behavioral finance theory.
We're generally in what people would call the swing trading area, which is anywhere from a few weeks to a few months. Okay. I'm generally not putting out 6 to 12 month calls. I think too much changes in the marketplace to really, lots of strategists on the street on January 1st give you their year-end target for 12 months hence. I think it's pretty difficult to know where a market's going to be 12 months ahead. Given how much goes on in the world, the change in the marketplace with instant feedback, whether it's Twitter or somebody texts you, if you don't answer back in 5 minutes, what's the problem? How come you didn't answer me? Everything's so quick now. Things change on a dime. So I like to position myself and tell our clients, we're here to help you capture the next significant move in the market, whichever way it comes. And we'll play either way. I don't care if it's bullish or bearish. We're going to help you play what comes next. So only twice this year have we hedged long books for long onlys. 3 days after the market high in January and 4 days after the all-time high this year. That's the only times that we've hedged, and we covered both fairly well, although I will say last week, or actually Monday, I got caught a little bit on, the big bounce Monday, and we made some money on the hedge, but we paid, towards the high end of this week's range for half of the hedge. The other half we bought on the low of the move. So we look to kind of have you in the right place for moves, but we also have, that's the institutional product. I have a more individual investor product called In the Know Trader, and it's available at inthenowtrader.com. You can read about it. This is a tactical trading report that we put out every Wednesday night to clients. So these are shorter term trades, usually with just a couple weeks maximum, intent of pulling a few percent out here and there. Using idle cash to take advantage of opportunities that present themselves in the market.
Now, thank you for telling the audience about that. We only have so much more time left, and I want to get some more. And just think of this as your first interview, not your last with us, because you and I can talk shop forever, and we'll probably get some people's eyes rolling back in their head when we get into it. Bond market is another place that you focus. I wanted to ask your opinion on this. When people get scared, they go into bonds. When people panic, they go into gold. Yeah. Give me your thoughts on what's going on. Let's start with the bond market.
Okay. So I do believe the long-term bottom in yields is in place. And we've been tracking this for years. And we finally got our signal at the end of March this year when 10-year yields closed above 2.72%. We definitively call the end of the 35-plus year bull market in bonds. That doesn't mean yields have to shoot to the moon. It means the bull market's over. So we can spend years even going back and forth in ranges. We set out a target of 3.31% on the upside, and we got to 3.25% on this year's peak. So we got 98% of the way to our target. The good thing is that, oh God, I think it's 3 weeks ago, we turned tactically bullish bonds. Yields were about 3.15 or so. And then we wrote this past Sunday night in our macro global trends letter to institutional clients that if you break under 3, you're going to put a lot of hurt on people who are short bonds. We're down to the 280s today, and there's some real pain in the bond market. So I'd have to, I don't know, I didn't look to see where I would expect yields to short-term bottom in here. But I do think, look, we have a long-term double bottom at 1.4%. I think it's a done deal there. Could we get as low as 2.5% in 2019? If we do, that's where I'd be selling bonds.
Okay. Why are we seeing more movement in bonds than we are in gold right now? It's basic. But why is there just more comfort there, or not enough panic in the market yet? Well,
the bond market is a much bigger market than is the gold market, so that's one thing.
Right.
You've got far more players with positions that need to adjust for what's going on. Gold is not completely dependent upon the dollar, but certainly the dollar has influence on it. We are tactically long gold. We have been for about 2 weeks. But I keep telling clients, I'm not convinced the investment low has been made yet. So I'm only looking at make 20, 30, 40 bucks in gold on the upside here, and then we'll probably kick out. In fact, I think we're close to 20, so I'll start perhaps taking a little off. We also were 3 or 4 weeks ago, we turned bearish the dollar, and we told clients using the DXY, the U.S. dollar index as the benchmark, to look to exit all speculative trading longs between 97.40 and 98.30. And we've twice gone up into that range. We've pulled back. We're in the 96 handle now. It's not like we're getting, killing the dollar, but this is helping gold a little bit. And I think the dollar's due for a little pullback.
I agree. We have covered just about everything that you do, and I'm glad to have been able to have this interaction with you about what we're doing. How can our viewing audience reach out to you to get deeper insights to what we brought to today's table?
So I have a kind of the umbrella organization for all the different businesses I have. Easiest way to get me, let's say, is by email, rick@thebensignorgroup.com. It's simple. We have intheknowtrader.com as our institution, as our retail individual investor newsletter. And the next time we talk too, we'll talk about some of the other things I do, because I do a ton of corporate training at Wall Street firms. And I'm also a performance coach for financial advisors, especially incorporating behavioral finance into their conversations with clients. This is the talk on the street. The most significant change in the way financial advisors have done business in 30 to 40 years is understanding behavioral finance and its impact both on their own approach to how they think about money, as well as understanding what clients do and how they think about it. Look, if you're a therapist, you have to go to years of therapy before you can be a qualified therapist in the U.S. We think that financial advisors need to go through the same type kind of retraining and understanding what behavioral finance is as it specifically relates to wealth management. And then once they understand their own relationship to money, they can much better create the relationships and sustain relationships and retain clients over time, which is always the most important thing for them, is client retention. So I do a fair amount of performance coaching there too.
Yes, we're going to have serious conversations as we go forward. I'm so glad you took the time to be on our show today. I'm glad to have met you today, Rick.
Well, thanks so much. It's been a pleasure, and I look forward to seeing you again, Michael, and having some really nice conversations.
Me too. All right, you've been watching CEO Money with Michael Yorba. Thank you for joining with us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.